All right. Good evening, everyone, and welcome to the fourth edition of Founders Thursday. A quick intro. Founders Thursday is a monthly session hosted by the Founders Ally where we help early stage founders get investor ready. For this session, usually we bring in operators, investors, and ecosystem leaders into the room to help build founders and become more investor ready. My name is Blessing and I'm the founder of the Founders Highlight. I'm sure most of you know who I am already. So today's conversation is one I'm really excited about because a lot of founders only think traction alone is enough to raise capital, but we all know, or we will soon know, that's not always the case. Um, a quick one, today's theme is a fundable narrative why investors say no even when you have traction. We'll be unpacking what investors actually look for beyond growth numbers and why some startups get funded while others don't. Our speaker today is Pius Bankong. Please, founders, a round of applause for Pius. Pius is a VC investor at Cube Capital and has also closely worked with high growth startups across multiple markets. He brings both operator and investor perspective into today's conversation, and I'm really excited to have him here with us. Pius, thank you so much for joining us. The floor is yours. Founders, please, clapping emojis. We need to welcome Pius to the floor. We can do
Hi,
better. We can do better,
hi,
founders.
Blessing.
Hi,
Hi,
Pius.
everyone. How you all doing today? Thank you for having me. It's great to definitely be able to just speak and connect. So yeah, thank you. So just like Blessing has said, let me also introduce myself. My name is Pius. Right, I currently work as an investor in the We Capital team. We Capital is a venture capital firm that invests in early stage startups right across Africa. So we invest at the pre-seed, seed, and pre-series A levels. We are sector agnostic, so we invest across sectors. Right. Prior to joining We Capital, I had, also been an operator in startups. Right. So I had led business operations at a YC company called Waza, which does cross-border payments. I'd also founded my own startup as well. Right. And I've also advised quite a number of startups, some getting into reputable programs like accelerator programs like Google for Startups, others also winning, grants and stuff like that worth millions, right? So I've worked on both sides. I think that's just what I'm trying to draw out here, right? Today's topic is very interesting. It's very interesting. I think it's also very timely because again, having been on both sides, I understand what it feels like when it's like you're building something, you know, you obviously want it funded, right? But then it just feels like you keep hitting brick walls. And I think what's just operating over time, I think I also forgot to mention, even while as an operator, I had also, helped in raising capital. So I'd helped in raising over about $5 million. I think between $5 to $8 million. I can't remember the exact figures right now. Between the different companies I had worked at, right? So it can be frustrating just having to go through that process. Whether you're raising money or you're not raising money, fundraising is a very stressful process in and of itself, right? It's distracting because it takes you away from running your business, which is always is and should always be the most important thing. But I find it very necessary, right? Also now being on the investor side and having had that experience to be able to just share what it looks like, from a balanced perspective. There are three things I'll be discussing today on, if typically it's very normal for you as a founder to have tried to raise and an investor says, oh, would like to see more traction. And then you go back, you get some traction and then you go back and then the investor is still like, oh, sorry, this is just not the right time or this is not a fit. But what I really want to give you context of is what happens, what's really happening under the hood whenever you have that experience, right? And it's for two reasons. The first reason is just so it helps you understand, it helps you understand your business better and it also informs you as to what you can do, right? Or what you need to do, right? So I'll start with the first reason why you could have traction and you still get a no, right? And that reason is fund construction, right? So what you find is every VC firm. Let me walk you through the anatomy of a VC firm. In fact, just so you understand how investors think, right? Just the way a startup goes to raise money from VCs, VCs also raise money as well, right? So VCs operate what we call a fund model. You raise money from a group of investors who are called limited partners, right? And you aggregate that money, right? These limited partners could be HNIs, pension funds, endowment funds, and the like, right? So you aggregate capital from them, and you're basically able to aggregate or fundraise from them because they believe, oh, you have a pulse on, what's happening in the ecosystem, what startups are worth backing, right? And the promise is when you raise that capital from them, right, they're looking for you to return a multiple on that capital. So I'll give you an example. We Capital invested in Money Point, right? And they invested out of a $4 million fund, a $150,000 investment. And a partial exit from that investment, when Money Point had grown, was able to return double the entire fund size, right? So those are the expectations that VCs are under. And it's a model where it's higher risk, it's also higher return, right? So it's a model where, that 150K that's returned double the fund on that single investment, it was 53x, right? So you're looking for outsized returns, which means you're also investing in ventures at a much riskier stage. And the numbers just say 9 out of 10 would likely fail, right? Just because startups are incredibly hard, right? So each VC invests according to their fund dynamics, which is okay, what's the size of the fund? The size of the fund determines, at what valuation they would invest. It determines what their check size would be, right? So if I have a $4 million fund, I can't invest $2 million in one company because that means for a space where 9 out of 10 companies will die, if I've invested half of my fund in one company, statistically, I've almost damned my fund, right, to possibly dying, right? You get my point. So sometimes a VC would reject you just because you don't fit into their fund dynamics, right? A VC may know, oh, this is the size of this industry. And if this is the size of this industry, if we're investing in a company, we target to own a certain percentage, maybe 5% of that company, right? And if you're priced at a certain number, right, that does not allow them own that percentage, just from a fund dynamic and fund construction perspective, they are not going to go ahead to invest, not because there's anything wrong with your business, but just because it doesn't fit them. So the first thing you want to understand is this a case where I'm just not a fit with this VC, right? Or is this a case where, maybe this says something about my business, right? Some VCs also have a sectoral focus. So a VC who invests in, let's say, climate tech companies, if you're a fintech and you try to force the narrative around your company into climate, they most likely will be able to see it. So again, they are not investing not because they don't like what you're doing, but they are not investing because it's not a fit with their fund's mandate, right? So that's the first case. And in that case, what's important for you to just know is, you know, this is not a fit. So you want to go find investors that are a fit, right? And as a founder, when you're fundraising, that's also like before you reach out to firms, right? You should be able to do that research to understand, okay, what's the fund size? What's the check size they typically invest? At what stage do they invest, right? If you're pitching a Series A fund to invest in you as a pre-seed company, again, that's just not where they play, right? They know that if they invest at that stage, they're unlikely to return their fund, right? So you have to be able to match your company to the funds that are playing at your stage, right? That's the first thing. That's on fund construction, right? That's on fund construction. So you could see that playing across stage. You could see that playing across sector. You could see that playing across also, most of what to use pricing as well, right? Some funds, a lot of funds try to be disciplined with. So if a fund has said, oh, we don't invest in companies with a valuation below, let's say, 10 million, right? Or a fund says we don't invest in health tech companies, right? And you pitch to them, it's almost like an automatic rejection, right? So you may have the traction, your business may be growing, but it's still just not a fit for them, right? So you have to understand what each VC's dynamic is, and typically the best two times to do that are the call. Actually, first of all, before you even get on a call with them, you know, the website before you pitch or you reach out to them, however you do, whether through a warm up cold intro. And then the next is, past that stage, you obviously, if you're on a call with them, you want to ask those questions. You just want to understand, you want to match the research you've done against what they're saying and just, be sure that there's a fit there. So that's the first thing, right? The second thing is, you also want to think about your business profile and capital fit. So what do I mean? Right? Not every business is a venture backable business. You can have a business that's a great business, but it's just not a venture backable business. And I'm taking this point next because it's connected to my first point, right? So venture capital is typically best suited for businesses that have an asymmetric growth trajectory, right? So it's a business where it could start off doing, let's say, $10,000 in its first year, but by the next year, it's doing $500,000. By the next year, it's doing $10 million, right? It's great for hyper growth businesses. There are a lot of great businesses that, if you have to, if you had to fund them with venture capital, you would have most likely killed the business. So take businesses that need patient capital, like an industrial business. Those businesses do not hyper grow over a short period of time, but they consolidate over time, right? So imagine putting a Dangote through a VC model. What will most likely happen is the business will not self-actualize, not because it's not a great business. The evidence shows us it's a great business. It's just one. Going back to, again, fund construction, I forgot to mention, VCs operate under a 10-year fund model. So when you raise all that capital, the promise to the VC's own investors is, we have to return this we will return this investment within 10 years, and we'll return a multiple of that investment within 10 years. So that means they are also constrained by time. So a business that, say, needs 20 years to reach, a certain level of asymmetry or a certain level of growth would typically not be suited for, a VC fund that has a 10-year exit window. So now, there is not your business. Your business isn't bad. It's just not a match. It's just not. So you as a founder have to understand that, right? What happens most times when you have traction, but you're still getting that rejection? If it's a case of a capital fit or capital mismatches, you probably need to expend some more thought into what capital is actually best for your business, right? So some businesses are better suited towards private equity, right, where the growth expectations are not as asymmetric as VC, right? Some businesses are better suited towards credit. Some businesses will million this year to doing, most of what you use, to doing 10, 20 million the next year. And I'll give you some examples, right? Think of Corsa. Corsa was acquired by SpaceX this year for, I think, $60 billion. And Corsa is, at the time they started, is basically saying, oh, we're helping people. What we call vibe coding today, that was Corsa was one of the pioneers of that, right? We're taking a whole industry, we're taking the work software engineers do, and we're giving you AI that can do that, right? So highly risky business, high chance of failure, but there was a clear economic opportunity. And the challenge was just, you have to crack that opportunity, to get that there. And if you crack it, the returns are symmetrical, which is why a business like that can go from, zero or its first ever round in 2021, 2022 to being acquired for 60 billion today, right? Another example is when you look at a company like, I don't know if you're familiar with Bridge. Bridge was acquired by Stripe, right? And what Bridge just does is it helps you move from stable coins into fiat currencies like USD and the like, right? And Bridge was acquired by Stripe when it was just 2 years old for $2 billion, right? So again, it was because of the scale at which it was solving a problem that another company could say, oh, hey, I want to come buy it, right? And we have our local examples. We have the Money Points, we have the Pay Stacks and the like. So there's a certain scale you have to operate at, right? If I'm a VC fund, if I had, let's say, a $5 million fund and I put $200,000 in a company, even if I did a 3x, which would be a solid return for most other investors, right? It would be a solid return if I was an angel investor, because that means I get 3x multiple of my money. But because that 200,000 has to return at the minimum a 5 million. No, because I know that most of the other investments would fail, right? Just by statistics. So each investment has to have the potential to return the fund or a good fraction of the fund, right? So even if that 200K even if it 3x in 10 years, that means it's 600K, which means if all I had was a 600K return for a $5 million fund, that means all I can give back to my investors is 600K. So they gave me 5 million for me to give them back 600K. If you were an investor in a VC and they gave you that return, you will probably try to lock up the person if you can, right? So that's also the funding pressure that the VCs are under that then determines how they select startups, right? And that's fine if it's just not a capital fit, because there's capital that matches. Like I said, some companies are better suited for private equity, some companies are better suited for credit, some companies are better suited for grants, some companies are better suited for angel investments or other forms of alternative investments, say family offices, right? So it's doing the work to understand, your company, its growth potential and growth trajectory, right? Being able to understand your company's gestation period, right? Is this a company that, it can grow it may be very challenging, but can it grow asymmetrically in 5 to 10 years? Or is this a company that needs to gradually grow, maybe over a 20, 30-year period, right? So it's knowing what type of business and then connecting the capital to it, right? The third point then is, beyond the first to talk more about their external, right? They're more about, oh, is it a fit? Either, oh, is it a fit with the fund's mandate, or is this the right capital for my business? But the third is, it starts getting more internal, right? And it's even when you have traction, not all traction ranks equally, right? And the way to think about this is just look at it from a goal-oriented perspective, right? Why is a VC asking you for traction? They're trying to see that your business grows in a way that they can exit that investment. How do they exit investments? They typically exit investments if your business grows enough that the public markets want to buy shares in your company at a higher price than they did, right? So the whole point of VC is, I invest in you before, when it's still risky, when it's not obvious whether you succeed or not, but I can see if you will succeed, how you're going to succeed, right? And I take on that risk, and you build a business over time. I help you not just with capital, I help you with, with networks, with strategic support, various things, right? I help you with all of that, and over time you grow. And when you grow, if we're exiting through IPO, it's that, in the public markets want your company, so they want to buy it. It's the way today, if we could buy OpenAI shares, we most likely would buy it because we can see the company is growing, right? Or the way we go on Bamboo or, any of these other apps, Robinhood, and we go buy, what's the word to use, Google shares or SpaceX shares, right? It's the same thinking. So those companies were not always the way they are today. People invested in them when, they were very early and uncertain, but there was an opportunity that was on the horizon, right? And it's all the work and all the funding that has gone through, the various rounds of VC funding that they've gone through, and the founder, the founder grit and the founder's execution that has gotten them to the point where Pius can sit in Nigeria, open his Robinhood app and say, oh, I want to buy X amount of SpaceX shares, right? So it's at that point where Pius starts buying as an individual or as a retail investor, right? When SpaceX goes to the public markets, that say their first set of investors can then come in and can then exit, because you can sell those shares to the public. The other way is through mergers and acquisitions, where it's like a private company has seen what you're doing, they like what you're doing, and they're like, okay, you know what? I want to buy this company, so I want to buy the shares of the people who currently own them. And then that gives the opportunity for a VC like myself to say, oh, hey, I hold shares in this company, you can buy it now, right? Those are typically the two scenarios. Like that's typically what's happening there. So in either case, what would prompt that to happen is a business growing. And how does a business grow? Right? Which brings us to traction. The first thing is revenue, right? A business is performing well when it's making money. So if a business is not making money, right, you're already on a weaker footing, right? If it's not making money, you're already on a weaker footing. If we now want to go further, we now want to look at profits, right? So a business could be making money, but it's not keeping any of that money, right? If it's not keeping any of that money, that's a problem because it means it would need to keep being funded by external capital, right? It can't run its operations. So even if the business raises funds, it's raising funds just to run, not to generate more money, as opposed to a business who is making money and raises funds to generate more money. So it's like it's a cost center, it's not a profit center, right? So with traction, you see sometimes where companies are like, oh, companies sometimes report activity instead of outcomes as traction. So a company says, oh, we have X amount of users or we have X amount of signups. That's great. It shows that it's an indicator of demand, but in and of itself, it's not conclusive evidence of business performance, right? If you can't monetize it, it means without any investment, that business will not exist. And it means even if an investment is made, right, if that business does not start making revenue and become profitable at a certain point, the business would not be able to survive, right? So the first thing is understanding the kind of traction you have and understanding how to build towards the traction you need to have. Right. So that's the first thing. So you see situations where you speak to a founder and it's like, oh, I have X, like I said, I have X amount of users or I have X amount of signups, but there's no way to monetize that, right? Even apps like Facebook that look free, they monetize through ads, right? They monetize through ads, like they make a whole lot of money. Google, same thing, right? So you have to figure out a way to monetize your product for it to be a business. And it's when there's monetization, an investor can then look and say, okay, yes, so I'm funding this, right, to be able to scale this monetization, to be able to help this company scale in revenue, which is why typically when you're pitching, there's the question that will come up, okay, where does this money get you? I give you this money today, where does it get you? What an investor wants to understand is, if I give you this money today, how does it help you make more money, right? Because it's not a charity. They too have to go back to their own investors. So if there's no way you're making more money, there's already a problem there, or if there's no path to making more money, right? And then as the company graduates, investment stages, as you go towards the Series A's, the Series B's and C's, it starts also just now being about not just the money you're able to make. You need to be able to make money at scale, but you also need to be able to ensure that you're keeping a lot more of that money. Right, your unit economics need to be great. You have high profit margins. Those kind of things. Like you want to see that as well, right? So that's one. The second thing is, even when you have revenue, right, the stickiness of the revenue now comes in. So is this something that people pay once and they go, or is this something that people are willing to pay for over and over again? Right. So that's the next phase, right? So it's like, okay, phase one, let's even try and make money. Phase two is, okay, can we make this money consistently? Because again, if you make the money once and you can't make it next time, it means you eat today, but you'll be hungry tomorrow, right? So it's like, can we make this money, can we make this money consistently, the stickiness of it? Once we do that, we then now go into, okay, it's sticky, but how big is this? Because remember, again, venture capital, venture funding is all about scale. We only make returns if a company is at a certain scale, asymmetric scale. So it's like, okay, you're making revenue, it's sticky, right? But maybe the total of people you can sell to is just 50 people. Those are the total people that are interested in it. And let's say the total amount they will pay is 10,000 naira. Let's even put it in dollars. Let's say 50 people, total amount they will pay is $1,000. That means that the total you can make, the size of this opportunity is, even if everything goes well, is $50,000. And then if you're now asking me to put in, say, 300,000 in an opportunity that the total you can make is $50,000, it doesn't move the needle for me. Let me even now rework the math. Say the total you can even make is $1 million, right? And you're asking me to put in 300,000, and that 300,000, say you're telling me, oh, I want you to put it in at a 3 million valuation, which means what I own in that business is 10%. And if the total that business can make is 1 million, right? What that just means is 10% of 1 million is 100K. So I'm going to make even less than I put into the business, right? That doesn't make a good case. If all it could make me is 300K, still doesn't make a good case, right? Because that means I'm breaking even on the investment, but I'm making a loss at the fund level because that 300K is out of a 5 million, right? So it's that math, right? You have to carefully think through, right, when you're talking to a VC. And it's that's also why before I even got into this, I said the first thing you have to understand your capital fit, right? I've done I've done businesses where I realized I didn't need to raise VC money, right? And there were businesses that were cash flow generating businesses, but I realized the growth scale I would need once I take on venture capital funding is not a this business is not a fit for it. So if I put venture capital funding in, it's going to not have the best effect on the business. And I just decided I said I'll bootstrap this, or I would use an alternate means of capital to grow this business. Right. So it's very important, even though I'm a VC investor, like that's something I'm very clear about. Right. So it's very important to be able to make that distinction because that also influences how you will build your company, right? The kind of capital you take would influence how you build your company. So these things sound like three separate points, but they flow into each other when when you think about it carefully enough. One, they help you self-assess before you even have any conversation, and they help you prepare for what you then need to come armed with, right? At the point where you're saying, okay, I want to take this to a VC, right? And it helps you know, okay, when I'm asking for X amount of capital, right? Putting yourself in the VC shoes, and this is something I used to do even before like coming into VC. I've always had to do a lot of deal making work. So I typically have to put myself in the other party's shoes. It could be a strategic partner, it could be whatever stakeholders, and I'm like, okay, what is their own objective? What are they trying to achieve? And then when I understand that, I'm now able to see if what I'm proposing is a fit to what they're trying to achieve. Right. So even if you're a business that you can be venture backable, but maybe you're still at the stage where you have users, but you haven't been able to crack revenue, right? Or you're not, even if, because sometimes it's not even that you need to have, it's not always you need to have the revenue, because people ask this question sometimes and they're like, oh, some companies are funded pre-revenue, some companies are not. And I'm like, yes, right. From the outside, it may not be so clear to see, but what happens most times is it's probably a business where they understand exactly how they're going to monetize. They probably already have distribution access into the places they monetize. Say it's a B2B solution. They already have, strong relationships. They probably already even have sales contracts in, right? So it's like, yeah, technically they've not collected revenue yet, but there's a clear path to how they're going to, and they already have everything, in a row. Another business could be generating revenue, but it's clear that maybe the market opportunity has reached its zenith. So if you invest now, there's nothing more to capture, right? It could be, oh, it's just a small market. So whatever that case is, it may seem baffling from the outside, but when you look at it through this lens, you would see why, obviously, like one company might get funded and another might not get funded. And this does not necessarily mean it's a horrible business. It just means it's not a fit. But if at all it ever means, the business is not there yet, then it's actionable feedback that you can work on to say, okay, this is where I'm at. This is probably what I need to do. This is, what I need to do to get to where I need to get to. And that just makes it a whole lot easier to handle. So I think that covers all of it. I hope I've done justice to this topic. I hope I've answered any questions you came in here with. I think I'll now give the mic back to Blessing, and we could just have Q&A over the next 10 minutes.
All right. Thank you so much, Pius. I mean, you really dropped a lot of things, and I'm even sure the founders here they could testify. I can see the emojis, I can see the applause, I can see everything. Founders, please let's keep coming. I learned a lot myself, and thank you,
Thank
Pius.
you.
So
Thank
now the
you.
floor, I'm going to throw the floor back to the founders here. If you have any question, I'm sure we all have questions. Please just come in with your questions, and please, take with these 10 minutes for our questions. So please, the floor is yours, founders. If you have any questions, or mute, or you just type your questions in the chat box and I'll read it out. All right. Sean, please go ahead.
Okay. Thank you very much for the opportunity. Thank you, Pius. Thank you.
No worries.
Thank everyone. Yeah. So my question is just very simple. So as a founder, you talked about the angel investor and all that. How do you suggest somebody approach maybe an angel investor, for instance? What are the pointers on what they would likely want to know about the startup for them to even fund any startup like that? So I don't know. Is there any how will I put it down? Any specifications or something they are looking at, especially the angel investors?
Okay. Thanks for your question, Sean. So I would put a disclaimer that because I'm a VC and I'm not yet an angel, hope to be soon, but because I am, like, I would just put a caveat around my answer. But here's what I've seen, even from previously, like raising from angels in the past, myself as a founder slash operator, right? Generally, any investor wants to see that there's a pathway to returns, right? Um, because angel investors invest for themselves, they're a bit more flexible in what they can invest in. So there's some angel investors who invest because it's a sector they like, right? Typically, the earlier you invest, the higher a chance it is that you're also not just investing in the idea, but you're investing in the person, right? So it's almost like you're taking a bet to say, oh, I know this person. So you see, most times angel investors are typically, maybe it could be people you've worked with, or people who just know of you, or people who founded startups themselves, right? So they probably see, they probably think that see something in the founder and they're like, oh, there's something exceptional here, right? It could be this idea, or it may not be this idea, but I think this person is going to do something great. And I, just want to contribute my quota to that. So that's the first thing, right? If you don't know them, if they don't have a history of your background, most times just they hear your story, they understand why you're building what you're building, they can see an opportunity or a possibility that there's an opportunity there, and they're like, okay, I like to put my money behind this person, right? I think that's typically a good way to look at it. And anyone could be an angel investor, right? I mean, there are laws behind it, accredited investor and all of that, which you could just like check. You could just check, like, those laws around it. But point is, typically someone who's an HNI can very well be an angel investor, right? If they have that interest. So it's just typically someone who maybe cares about the sector, they have some innovation interest, they have the capital to invest personally, right? And if you're just able to speak to them, I find that most times with angel investors, approaching it not just as a pitch, but having a so much relational element helps, right? So them being able to understand you as a person as well, what your motivations are. Because again, now it's a human being investing. VCs, yes, are also investing as human beings, but there is that business, there's that commercial layer that's also there, because you have stakeholders to answer to. But as an angel investor, it's like I'm just investing for myself, right? So yeah, I think that's a good way to look at, or just to approach, speaking with angel investors. Try to understand the person. I think the ultimate feedback will be try to understand the person you're approaching.
Thank you, Pius. Sure, I hope that answers the question.
Yes, it does. Thank you very much.
All right, thank
No
you.
worries.
I can see Kingdom's hands up. Kingdom, the floor is yours.
Okay, good evening.
Hi,
Hi,
good
Kingdom. Good
evening.
evening.
Yes, first I want to say thank you to Blessing and Pius. Pius, you've been great.
Thank you.
Your, yeah, your presentation is awesome. Now,
Thank you.
yes, my name is Kingdom. I am the founder of
So sorry
mytablescore.com.
to cut in, Kingdom. Founders, we have just 5 more minutes for our questions and answers session to wrap up. So we have to hasten up, please.
Okay, okay. So my name is Kingdom Omar. I'm the founder of mytablescore.com. It's a no-click, zero friction, football-focused life score. I've been able to raise some funds from an angel investor, but the funds I raised is a little bit not exactly what I'm looking at, and I'm looking at raising more funds. But I found out that the process of raising funds from angel investors, or let's say VCs, is somehow difficult because most of these angel investors and the VCs, they ask a lot of questions. And for a product like mine that I just started, just built the MVP, you talk about traction. We really don't have much traction. And this is what they're looking at. So I want to ask, how can one beat this traction? Should I call it not trap? I wouldn't call it trap. This traction metric when you're starting a product like that, because life scores solely depends on adverts placed on the app or the website. So how can you beat this traction metric when you're building something like that? And also the series Prestige, Series A, B, and the rest of them. I will want you to throw more light on it so that we understand what each of these series entails, what you're supposed to do in each of these series. Thank you very much.
Okay, thank you, Kingdom. I'll run through the question quickly. Might not be able to cover everything because of time. I can see Nemesis also has his hand up. But what I'll say is the truth about, like when you say investors asking you questions is one of your biggest duties as a founder is you have to understand your business, your market better than anyone else, right? You have to be the person who can tell me where the opportunity is. Do you get what I'm saying? Right. So what that really just means is that at the end of the day, right, at the point you're approaching an investor, the implicit understanding is all that's left or all that's needed is money majorly, right? Capital to accelerate something that's already going on. So if you're at a phase where you're still figuring out certain fundamental things about your business, it's probably a pointer to spend more time seeing where exactly the opportunity is, where you want to play, right? So it could be a product where it's like, what's the word to use? We're going to spill over maybe by like 3 minutes. Blessing. Just wanted to. I have a hard stop, but just so I can answer, like 2 more questions, right? So it could be one of those situations. No worries. So it could be one of those situations where it's like you really just need to understand more where the opportunity is, right? And also another thing about a startup is a startup would never have all the resources it needs for most parts, right? So it's constantly finding a way to resourcefully get, to resourcefully validate that, okay, this thing works. Okay, this thing works. People want it. Okay, people want it. People want it over and over again. Okay, people want it over and over again. This is how much. So, for instance, maybe you shouldn't be speaking to investors here. Maybe probably look for incubator programs. Probably look for where they even help you, graduating that thinking as well to say, okay, this is a practical step-by-step way for you to go and get more validation, get more users, right? With that, you could now say, okay, let me even do grants, right? Let me do grant competitions. So like you have enough time to really experiment until you build that understanding of your business, right? I think that might be a more productive way to just think around it, right? And I think similar feedback I would also give to Joel, right? I think, like when you're at a phase where you've made some progress, but there's still, you want to figure out how can I deliver this solution, right? One, you have to think about if you're not attracting the funding you need yet, you have to think about, okay, even if I have traction, have I been able to arrive at a crystal clear understanding of how big this market opportunity is, right? The truth is, if you can clearly communicate this is market opportunity, this is how big it is, this is because it's also when investors are evaluating that you're looking at certain things, right? Okay, is there an opportunity here? 1, 2, even if there's an opportunity here, like is this the most skilled person to make this happen? It's the reason why you evaluate the market opportunity, you evaluate the team, right? You evaluate, the customer behaviors. You're looking at all these data points to see, okay, is this the right combination? Because sometimes you can get the market right, but you get the company wrong. Imagine Paystack and another company that was trying to do what Paystack was doing, and imagine I invest in the other company, and Paystack is the one that ends up exiting to Stripe. So there's also that opportunity cost element, which is why as a founder, your job is to ensure that you become that person who's the best suited person to do it, right? You're working on the right idea, you're the right person for that idea, and you're able to execute against that and capture the market, right? Like, I think that's just the advice or how I say to think about it. In MSs, please let me have your question.
Okay, good evening. First of all, I'm happy to be here. So I just wanted to ask how should I put it? I'm very big on believing that founders should always start earning from the very first day, like from day one when they launch.
Yeah.
Because if there's no revenue, then you don't actually have a business yet. But for founders that are building in the fintech space or in the banking sector, it's quite hard. Like, it's quite hard to start earning from the very first launch, specifically due to like regulatory concerns that actually require more capital. And let's say you just raised enough to build an MVP, but not enough to start generating revenue yet, due to like you have to raise more to gain, to be able to achieve that. So how would you advise that people who are building in this sector go about that? Like,
So I'll give you real life examples, because I've built in fintech, I've worked in fintech before now, right? So the first thing you want to do is, obviously, it's a regulated sector, right? So compliance is important. But remember what I said about a startup. A key part of a successful startup is being resourceful. So one thing you want to do is you want to think about workaround. Can you validate through licensed partnerships, right? Can you validate through licensed partners? Like, if you're able to do that, right? I've seen companies where it's like, okay, they have a licensed sponsor, right? They have a licensed sponsor, maybe they have a revenue share. They may not be making the most money from that, but they've been able to validate that, okay, this is what we earn, but this is what we're able to only keep because, what's the word to use? This is what we're able to keep because, we have this licensed partner. If we're able to acquire this licensed partner, then if we're able to acquire this license for ourselves, then this is what we will keep, right? And it's just a very good way to think about your business irrespective of the industry, right? Your capital story, whenever you're fundraising, the story should always be, this is where we're at, this is what we are seeing, this is exactly what we want to do, this is what we need to do it. And what you find sometimes is, typically an investor talks to, I can count for almost any industry this year that I've spoken to a founder in. I've spoken to maybe up to 10 founders, right? So when you talk to 10 different people, you have a sense of each person's depth of understanding of that problem, right? So that's also something to consider just when like you're engaging an investor. Like, they've seen that problem from 10 different sides, right? So when you see someone who has really taken time to really think about the various layers of the business, it's clear, right? It's clear in how they talk about it, it's clear in how they execute as well. When that's not the case, it's also clear, right? So yeah, that's pretty much it.
thank you very much. That was very insightful.
Yeah. Thank you so much, guys. It's been great speaking with you. It's been great speaking with you, and look forward to connecting, after now.
All right. Thank you so much, Pius.
Thank
Thank
you
you
so much,
to every
Blessing.
founder present. Thank you so much to every founder that asked questions. Your questions were really insightful, and I'm pretty sure your colleagues here as well, they were able to learn a lot. I can see someone's comments. Let me be the 11th founder you will talk to this year. Pius, over to you. But anyway, let's see how it goes. Hopefully, right?
Yeah, I mean,
Um,
my LinkedIn is in the
Yeah,
comments.
so
So yeah.
everyone, please head to our chat, the chat box. I shared with you Pius LinkedIn, and you can always connect with him for further discussions. Pius, right?
Yeah, yeah,
For further
yeah.
discussions. Also in the chat box, you would come across the Founders Ally socials, please connect with us. And we also shared our feedback form. We would need your feedback towards this session, and I mean upcoming sessions, on how we want to grow as a firm and as a company. And also, if this session was pretty amazing to you, you can book a clarity call with us and we'll take it further from there. Pals, again, thank you so much. This was a really insightful session. And all the founders, what do we say to Pius, please?
Thank you very much,
Thank you
Pius.
very much, Pius. Very
Thank you
interesting.
too.
I
Thank
can't
you. It was
hear
great
you.
speaking with you guys.
Thank
Thank
you
you.
very much,
Thank you,
Pius.
Pius.
All right,
No worries,
Pius,
no
thank you
worries.
so much.
All right.
Pius,
Bye.
I'll be linking up on LinkedIn. I'll be.
Yes. It's
All
good
right.
Nandi
Thank
is
you.
here.
Yeah.
All right, do enjoy the rest of your evening, Pius, and I hope we didn't make you so
Thank
late.
you. No worries. That's fine. Thank you. Thank you, guys.
All right, so founders, I hope this session was really insightful for you. From the emojis being shared, I I already have an idea that you guys really enjoyed this session, and I hope today's conversation has helped you all to understand that fundraising is not just about traction. There could be other factors, such as your positioning, clarity, investor confidence, and your market opportunity, amongst every other thing that Pius had shared with us. And once again, that's exactly what we help founders to do at the Founders Ally through our fundraising supports, readiness support, our pitch deck development, our pitch strategy, our clarity sessions, our pitch flow sessions. If you need more in depth, again, I shared uh, Calendly link in the chat box. So do well to book a fundraising or clarity session with us. Thank you everyone for joining us. I will see you at the next edition of Founders Thursday. Please note Founders Thursday holds every second Thursday of the month. Bye.
Bye.